Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. So today we're diving into what feels like a really frustrating mystery. If you've been following the markets, you know the U.S. banking system is, well, theoretically, it's sitting on about $3 trillion in excess reserves.
An enormous number.
A huge war chest of liquidity. I mean, it sounds like the whole financial system should just be swimming in cash.
It absolutely should. If you just look at the raw numbers, we have,
Yeah.
historically ample reserves in the system.
Exactly. But here's the paradox we're going to unpack. In November and December of 2025, we saw these repeated, sharp, just undeniable signs of stress.
Of money congestion.
Yes, money congestion. We're talking about the secured overnight funding rate, SOFR, and the repo market. They were spiking over and over. The money just wasn't flowing.
And that tightness was the warning flare the Federal Reserve just couldn't ignore.
So they acted.
They acted decisively. On December 10th, they announced they were starting something called Reserve Management Purchases, or RMP. Basically, they're going to actively buy short-term Treasury bills. And they started almost immediately on December 12th.
Okay, so let's unpack this. Our mission today is really twofold. First, why does $3 trillion act like a traffic jam when the roads are supposed to be clear?
And
Second, what exactly is RMP? The Fed is adamant this is a technical move, not economic stimulus. We need to figure out if that distinction really holds water and what it means for you, the investor.
our goal is to get past the headlines. You really need to understand the structural failures and the financial plumbing that forced the Fed to step in.
And how this technical fix might just change the whole game for monetary policy.
Exactly.
Let's start with that central puzzle then, the paradox of plenty. If Bank A has reserves and Bank B needs a quick loan, why not just trade? Why did the repo market, which, it handles hundreds of billions of dollars a day, why did it keep seizing up?
The problem is fundamentally structural. It's driven by regulation. Having a huge quantity of reserves doesn't mean banks are actually free to lend that cash out.
So it's not a supply shortage. It's that the system itself is choked off by its own rules.
That is the friction point we've identified. And the main culprit here is what we'd call regulation-based rigidity. Banks are operating under these incredibly strict requirements for liquidity and capital.
Okay, so things like the liquidity coverage ratio, LCR, and the big one, the supplementary leverage ratio, the SLR.
Those are the ones.
We hear those acronyms all the time, but let's break it down. How do those rules turn $3 trillion in cash into this rigid safety net?
Okay, so take the LCR. That rule says banks have to hold enough high-quality liquid assets, and cash reserves are the best kind, to survive a 30-day stress scenario.
So the money isn't there for lending.
No. It's a legally mandated safety buffer. It's not operational cash.
It's the money in the vault labeled, in case of emergency, break glass.
A perfect way to put it. And when stress periods hit, and that's usually year-end or maybe a big quarterly tax deadline that pulls cash out of the system, the banks get super conservative.
They don't want to touch that buffer.
They're terrified of dipping below those regulatory minimums. So they pull back from the market, and that withdrawal of capacity, it instantly amplifies these small shocks into sharp rate spikes. That's your money congestion.
So even though the reservoir is full, the pipes leading to the houses are too narrow for peak demand.
That is a perfect analogy. And a recent analysis pointed out that the real telltale sign was the spread between repo rates and the Fed's main policy tool, the interest rate on reserve balances, or IORB.
When that spread widens.
It's proof that reserves are no longer ample enough to overcome that regulatory friction.
What I find fascinating is that the data seems to suggest the distribution of reserves and the friction in the system are now way more important than just the absolute number.
Especially since the Fed has been shrinking its balance sheet with quantitative tightening, QT, which has been slowly pulling reserves out of the system anyway.
And the Fed is kind of flying blind here, right?
They are. We've seen reports where the Fed itself admits that calculating the exact appropriate level of reserves is, and I'm quoting here, an inexact science.
So they don't know how narrow the pipes are until the water stops flowing.
Exactly. And that visual evidence in late 2025, that rising repo IORB spread, that is what pulled the trigger on RMP.
Okay, to understand just how fast the Fed acted here, we have to talk about the boogeyman in the room.
The 2019 trauma.
Absolutely. The September 2019 repo market seizure, that event seems to have permanently changed the Fed's whole risk calculus.
It was a shocking event. For anyone who might have forgotten, the repo market just blew it to ground to a halt overnight. The Fed had to jump in with emergency cash, just to stop rates from going to the moon.
And research has shown pretty clearly that in 2019, it was this combination of declining reserves and just this sudden defensive behavior from banks and non-banks that led to that dangerous instability.
That event showed everyone exactly how fast the plumbing can break when reserves dip below that unknown critical line.
It really does sound like the Fed is suffering from a kind of financial PTSD.
I think that's fair.
They saw the plumbing break once, and now they're reacting to every little tremor. They seem to define sufficiently ample reserves as way more than enough to guarantee 2019 never ever happens again.
And that caution explains the timing. The market was mostly expecting the Fed to wait until QT was done, maybe well into 2026.
But they jumped the gun.
They did. Immediately after pausing QT, they launched RMP on December 12th, pledging to buy about $40 billion in T-bills every month. That is pure preemptive action.
Which brings us to this crucial distinction. The second the Fed says it's buying bonds, the market just screams, it's quantitative easing. QE is back. But the Fed was so careful with its language. They keep saying this is not policy easing. Why are they so hung up on that distinction? Is it just semantics?
It's not just semantics, although I totally get why the market simplifies it that way.
Sure.
Traditional QE is a broad macroeconomic tool. The goal is to suppress long-term interest rates, to, stimulate borrowing and risk-taking across the whole economy.
It's about changing behavior.
Yes. RMP, on the other hand, is defined as a technical adjustment. Its objective is super narrow: stabilize short-term rate control, and fix that internal plumbing friction.
And they're doing that by only buying short-term T-bills.
Exactly. So by doing that, they inject cash reserves directly into the banking system without necessarily pushing down the long-term yields that drive, say, mortgages or corporate investment.
But let me push back on that. If the effect of buying bonds is a massive injection of liquidity and less stress, isn't that functionally friendly to asset prices?
Oh, absolutely. It's an issue of intent versus effect. Their intent is accident prevention, not stimulus.
But the market doesn't care about intent.
The market just sees green. The reality is that any increase in central bank liquidity, technical or not, it creates a favorable backdrop for risk assets. It's rocket fuel for short-term sentiment, even if it doesn't solve the long-term growth picture.
So RMP is basically the Fed applying emergency lubricant to a system that keeps seizing up. But the sources we've looked at suggest this is just a temporary fix, that regulators are also focused on strengthening the plumbing itself.
And that's the key structural element. If the problem is regulation, you have to fix the regulation. And there was significant discussion in November 2025 aimed right at the design of the supplementary leverage ratio, the SLR.
Why is the SLR the villain in this story?
It's all about how the calculation works. The SLR requires banks to hold a certain amount of capital relative to their total assets.
Right.
But here's the kicker.
Okay.
When banks hold more treasuries or more cash reserves, those safe assets actually swell their balance sheet. That increases their capital requirement.
Wait, so the banks get penalized for holding the safest possible assets?
Exactly. They face a regulatory penalty for doing what the market needs them to do during stress, which is intermediate treasuries and lend cash.
That seems broken.
It's a major point of friction. So regulators are talking about adjusting the SLR to allow banks to handle more of that business during stress periods without getting slammed. That's the real long-term fix to widen those pipes.
That feels like a much deeper solution than just pouring in more cash.
It is. And on top of that, the New York Fed also moved to adjust the operations of its standing repo facility, the SRF, in early December.
The SRF is kind of the permanent, always open emergency window, right? The ultimate safety valve.
That's the one. The adjustments were made to ensure liquidity is stable and accessible to more players when they need it. It's basically the Fed officially saying, look, when regulation forces banks to step back, we must be ready to step in.
Okay, so we've broken down the cause, the diagnosis, and the fix. Let's get to the most critical part. The so what for our learner. What are the key takeaways from all of this?
Okay, key insight number one. This fundamentally changes how you should measure market health. It's no longer just about the total quantity of liquidity, that $3 trillion number.
Right.
It's about the capacity to intermediate that liquidity. Intermediation capacity is now king.
So if I'm watching the market, I need to look past the big headlines and focus on the plumbing variables, the things that actually measure stress.
100%. You should be watching things like the spread between repo rates and IORV. If that spread is widening, it means friction is building.
And that banks are starting to hoard cash.
Yes. And you should be prepared for more short-term volatility, maybe some temporary widening of credit spreads as liquidity freezes up.
Which leads us right into insight number 2. This confirms that policy is now a multi-lever system. It's about managing the price, the interest rate, and the quantity, the balance sheet.
And this separation is so important for investors. You have to separate the asset price reaction from the real path of the economy and inflation. Meaning, this technical liquidity from RMP might boost risk assets in the short term, but it does not automatically mean the economy is getting stronger or that inflation is coming back. It's not traditional QE.
If you confuse accident prevention with stimulus, you could really misjudge the big picture.
You really could.
Okay, and insight number 3. What about the bond market specifically? The Fed is only buying T-bills here.
Right. So RMP definitely strengthens the Fed's control over this short-term bond market. It provides stability at the front end of the curve. But the source material is very clear that long-term rates are still being driven primarily by huge fiscal factors.
Government spending and Treasury issuance.
The massive supply of new debt. So the Fed is fixing the short-term plumbing, but they are completely hands-off when it comes to the duration risk caused by all that federal borrowing.
So that risk, the long-term rate volatility, it stays with the private sector.
Precisely. The Fed isn't suppressing long-term yields, they're just stabilizing the funding machine.
So before we wrap up, let's nail down a quick risk checklist.
Right.
Even with RMP running, can we still see these funding spikes happen?
Oh, absolutely. RMP is an ongoing treatment, not a cure. The underlying regulatory issues aren't fixed yet, so you have to anticipate potential spikes around those predictable moments, year-end, quarter-end, big tax days.
And when those spikes happen, what are the immediate ripple effects we should watch for in a portfolio?
Okay, 3 things. First, watch for the forced reduction of leveraged positions, people having to sell because borrowing costs just jumped.
Margin calls.
Well, that's number 2. Watch for sudden margin calls if collateral values shift.
Yeah.
And third, look for a temporary widening of credit spreads as everyone rushes to cash. Those are the 3 immediate things to watch for.
Got it.
So, to summarize our deep dive today, the market tightness we saw wasn't from a lack of money. It was from structural friction, a lack of intermediation capacity caused by regulation.
And RMP is the fix.
It's a technical accident prevention measure. It's rooted in that harsh memory of 2019, and it's designed to lubricate the clogged pipes of the banking system.
And here's a final provocative thought for you to consider. This whole episode, the RMP, the regulatory talk, it confirms a really profound philosophical shift. We are now officially in an era where monetary policy will consistently involve this combined operation of the policy rate plus balance sheet management.
The two-lever Fed.
Exactly. The Fed's balance sheet isn't a temporary crisis tool anymore. It's now a permanent, active instrument for managing financial stability. The game has changed. Don't forget to subscribe and hit that like button.